Welcome to the CFA Level 1 practice test. Domain, Financial Statement Analysis. Part 6. A company reports consistently positive cash flow from operations that exceeds its capital expenditures, regularly pays dividends, and reduces debt. This cash flow pattern is most consistent with a company that is A. Experiencing rapid expansion. B. In its initial phase of development requiring external funding. C. Generating stable profits and returning capital to shareholders. D. Not applicable. Answer is C. Generating stable profits and returning capital to shareholders. Given a return on equity of 12%, dividend payout ratio of 25%, current share price of $50, and expected next year's dividend of $2, what is the required rate of return closest to? A. 9%. B. 4%. C. 13%. D. None of the above. Answer is C. 13%. For a 5-year lease with annual payments of $20,000 and an 8% interest rate implicit in the lease, what is the present value of the lease liability at inception? A. $79,854. B. $84,247. C. $100,000. D. Not applicable. Answer is A. $79,854. Which financial statement analysis technique is most appropriate for comparing profitability of two companies with significantly different sizes? A. Trend analysis of net income. B. Common size income statements. C. Calculation of the debt-to-equity ratio. D. Not applicable. Answer is B. Common size income statements. If the yield curve becomes increasingly upward sloping, which characteristic most likely contributes to expansion in a commercial bank's net interest margin? A. Interest rates for long-term maturities exceed those for short-term maturities. B. Interest rates for all maturities remain constant regardless of time frame. C. Interest rates for short-term maturities exceed those for long-term maturities. D. None of the above. Answer is A. Interest rates for long-term maturities exceed those for short-term maturities. A significant motivation for management to issue lower quality financial reports is most likely to A. Manipulate the company's reported earnings to meet analyst expectations. B. Provide decision-useful information for long-term investors. C. Improve the company's credit rating through transparent disclosures. D. Not applicable. Answer is A. Manipulate the company's reported earnings to meet analyst expectations. During rising inventory costs, changing inventory valuation from FIFO to LIFO would most likely report A. Higher current ratio. B. Higher gross profit margin. C. Higher debt-to-equity ratio. D. Not applicable. Answer is C. Higher debt-to-equity ratio. Under IFRS, the classification of interest paid in the statement of cash flows is best described as A. Must be classified as an operating activity. B. Must be classified as a financing activity. C. May be classified as either an operating or a financing activity. D. None of the above. Answer is C. May be classified as either an operating or a financing activity. A statement says goodwill will be amortized over its useful life and reviewed for impairment annually. This statement is A. Incorrect because goodwill is not amortized but requires annual impairment testing. B. Incorrect because goodwill is only impaired if indicators are present and amortization is not permitted. C. Correct, goodwill is amortized and subjected to annual impairment tests. D. Not applicable. Answer is A. Incorrect because goodwill is not amortized but requires annual impairment testing. If Company X has a significantly higher efficiency ratio than Company Y in the same industry, the analyst is most likely to A. Focus on Company Y's liquidity since higher efficiency means lower cash reserves. B. Conclude Company X is more operationally efficient and investigate reasons for this difference. C. Recommend Company X as a buy without further analysis based on higher future earnings per share. D. None of the above. Answer is B. Conclude Company X is more operationally efficient and investigate reasons for this difference. Thank you for watching. For more learning videos and tutorials, subscribe to BISP Trainings.